Hey everybody, it's Randy Pierson, Vice President of Life and Annuities for Gordon Marketing, and today I'm sitting here with our manager of the Your Family Bank program, our most successful life insurance selling program here at Gordon Marketing. And today we're going to be talking about the subject of perpetual uninterrupted compound interest in life insurance. Stay tuned. All right, Paul. Long, big words, fairly complicated sounding subject for today's video. Perpetual uninterrupted compound interest. What are we talking about today?
Well, what we're really talking about, Randy, is the bedrock fundamental of what makes the whole Your Family Bank concept work and what makes cash value life insurance, be it an IUL or a whole life product structure, work as well, because without that, we wouldn't be able to have the kind of magic that we do. So, getting into it, it's as simple as this. We pay a premium into a policy, and that premium goes to part of it to the cost of insurance, the death benefit,
Okay.
and the rest is going to the cash part of the policy.
Okay.
Now, think of it as stepping on a balloon. We can put our foot on that balloon either at the death benefit end or the cash end, and as I suppress the one end, the other end blows up. So I can have no cash in that policy, have all death benefit, right? Or I can suppress the death benefit down to the minimum to increase the cash part of the policy, right?
Excellent.
So as a banking concept or as a efficiency structure for the banking concept or savings structure, we want to minimize the death benefit, increase the cash, okay? But as that cash goes in with more premium every month and the principal is earning interest and the interest begins earning interest, right? And that continues to grow. At some point, we want to pull money out of that policy, right? Mm-hmm. Either through a loan or a withdrawal. But the beauty of it is this. When we take the money out of the policy, it doesn't actually come out of the cash account. It comes as a loan against the death benefit. And that's where most consumers and most agents even get a little bit confused. So let's.
So the policy is collateralizing the loan.
Correct. So think of it this way. In every other situation where I'm going to accumulate money and then borrow it, okay, think of a big cookie jar sitting here, and every week you came home and you threw your paycheck into that cookie jar. Mm-hmm. That could also be a Schwab account. It could be a bank account. It could be a money market account. It could be anything. But what we're always doing in those situations is we're funding it into that bank or that account, and then we're borrowing from the account to go spend, right?
Right.
Okay, so it's money in, but it's money back out of that same account.
Right.
But what if I told you, no, keep accumulating your paycheck in that cookie jar, but instead of you spending from that account, I told you to borrow somebody else's money at a lower cost than the continuous compound interest you're earning over here, okay? So that this cookie jar would grow ever and ever bigger and bigger, and that's why they call it infinite banking, okay? Because it's getting bigger and bigger all the time. It's earning more and more interest, okay? And the money I'm borrowing over here is a decreasing account at a lesser cost than I'm earning over here. Yeah. That's the magic. That's the perpetual uninterrupted compound interest, because this account over here is never going down.
Yeah, and it never ceases to amaze me that most advisors that may be very intelligent, very life insurance IQ intelligent, have never really gotten that concept, right? They've not grasped the idea of how that dynamic works. But what I find really fantastic about the Your Family Bank program is the fact that we utilize that concept to provide, cash to the consumer to accomplish objectives. But in this program, in the Your Family Bank program, we're accomplishing one of the most important objectives that consumers want to address, and that is paying off debt, right? I mean, paying off debt. And so, in this scenario, I think that alone, right, taking a complex subject matter and turning it into a simple idea that we can get you out of debt much sooner than if you were to utilize the payment methodologies provided by the creditors, right?
Correct.
So for those that aren't familiar with the Your Family Bank program, why don't you give the agents an idea of what kind of time frames that utilizing a well-funded, in this case, whole life policy, we can pay off some of that consumer debt?
Well, what we report to our agents that get involved in the program is that on average we can get all their debts gone in 9 years or less. That's on average. So you're going to have some that are gone in 5 to 6 years. You're going to have some that might take 12 to 13 years. But on average, we're able to eliminate all their debt, including student loans, mortgage, all the big ones, in 9 years. Most of the time, the consumer debt, meaning everything but the mortgage maybe, is all gone in 2 to 3 years at the very most, sometimes less than 2 years.
Yeah.
So it can have an immediate impact. Okay, so go back to that cookie jar analysis again for a second. Doing in an account where we're spending from the account, which is kind of the Dave Ramsey solution, right?
Sure.
We are able to get out of debt, okay, but when we're out of debt, other than the freed up cash flow and not being in debt anymore, I don't have an asset anymore because I spent from the asset in order to pay the debt off, right? In the Your Family Bank methodology, however, not only do we have the debt eliminated and the cash flow freed up, but I have an asset to show for it as well because that compound interest and that growth was never interrupted and taken away.
Yeah. So we're running out of time here, but let's quickly address one of the biggest questions that I get when I'm chatting with agents about the YFB program and utilizing a life insurance policy as this accumulation and distribution vehicle. What about taxes? Real quickly, what are the tax implications for consumers utilizing this strategy?
Well, that's one of the beauties of using life insurance. The very first thing that life insurance should be your first go-to as an option is it multiplies your estate right away, right? If I put X number of dollars in, I have 5 times X in terms of death benefit. Right. Should the inevitable, although not imminent, maybe inevitable, is going to happen to all of us, right? Okay. But the other thing is all the interest growth that's accumulating on the way grows tax deferred. And if we take it out as a loan, because loans are not taxed, the loans come out tax free as well. Yeah. So we beat Uncle Sam all the way around the horn.
There you go. There you go. And anytime we can beat Uncle Sam, we're all about that. So agents out there, if you want to learn more about the Your Family Bank program in general, or the more technical uses of life insurance in helping meet consumers' objectives, you need to reach out to Paul Bechtold. He's one of our top RVPs here at Gordon Marketing. He's always available to talk to agents to help you grow your business. But with that, we got to call this episode of Selling Life and Annuities to an end. I would encourage you to please click subscribe underneath this video and also that notification bell. So when we come out with a new video every Tuesday, you'll be notified, you can watch, and we can help you grow your life and annuity sales. With that, I'm Randy Pierson. This is Paul Bechtold. Thank you for watching. We'll see you next Tuesday.